Variable Universal Life Insurance for the national portion of the life insurance exam combines the flexible structure of universal life with the investment risk of variable products. On the exam, you will see this described as a policy that offers both flexible premiums and a variable death benefit based on the performance of separate account investments. Unlike traditional whole life or even standard universal life, there is no guaranteed minimum cash value in a variable universal life policy. This means the policy owner assumes all the investment risk. If the sub-accounts perform well, the cash value and death benefit can grow significantly. But if the market drops, the cash value can plummet to zero, which could cause the policy to lapse unless the owner injects more cash. One of the primary ways the exam tests variable universal life is by comparing it to other policy types. You must remember that the word universal always implies flexibility. Just like a standard universal life policy, variable universal life allows the policy owner to skip a premium payment or change the amount they pay, as long as there is enough cash value to cover the monthly mortality and expense charges. It also allows the policy owner to increase or decrease the death benefit, although an increase usually requires proof of insurability. The variable component means that instead of the insurance company's general account backing the cash value, the money is held in a separate account. This separate account is divided into various sub-accounts that look and act like mutual funds. Because these are considered securities, the sale of variable universal life requires dual registration. You must have a state life insurance license and a federal securities registration, such as a Series 6 or Series 7. This is a high-yield exam point because they will often ask which license is required to sell a product with flexible premiums and investment sub-accounts. A common trap on the exam involves the death benefit options. Just like universal life, this policy typically offers Option A, which is a level death benefit, and Option B, which is an increasing death benefit. Do not get confused and think that because it is a variable product, it only has one death benefit structure. Another trick involves the word guarantee. If a question asks which policy guarantees a minimum cash value, the answer is never variable universal life. Even though the death benefit might have a minimum guarantee in some variable products, this specific policy is noted for its lack of cash value guarantees. To keep these straight, remember the mnemonic that variable universal life is very unpredictable and loose. The unpredictable part reminds you of the market risk and lack of cash value guarantees, while the loose part reminds you of the flexible premiums and adjustable death benefits. On your exam, you might encounter a scenario where a client wants the potential for high market returns, but also wants to be able to stop paying premiums during a lean financial year. In that specific case, variable universal life is the correct answer. Remember that because the policy owner is choosing where the money goes through sub-accounts, they are the ones steering the ship and taking the risk. If the exam asks who bears the investment risk in a variable universal life policy, the answer is always the policy owner. Also, be prepared for questions regarding the prospectus. Since this policy is a security, a prospectus must be delivered at or before the time of solicitation. This is a non-negotiable legal requirement that is frequently tested to ensure you understand the regulatory environment. Finally, remember that the policy is regulated by the Securities and Exchange Commission, as well as the Financial Industry Regulatory Authority and the State Insurance Department. When a question asks about the primary difference between universal life and variable universal life, look for the answer that mentions the separate account or the transfer of investment risk to the policy owner. Understanding these distinctions is the key to mastering the life insurance exam and avoiding common pitfalls.